I have a few mechanical announcements first. Would you all, at the end of this lecture, leave the room by the door to my right in order to be assigned to your group rooms? That's the door right here. And those of you who are watching by television upstairs, I'll have to ask you to come down to this room and also go out this door to pick up your group assignment, because the girls want to keep track of the number of people in each room. One other thing, if there are any group instructors here who have not yet picked up their material and got their room assignment, including any standby instructors who are no longer standbys, would they please check with Mrs. Cleary at 11 o'clock. She'll be in the corner desk just off to the left from this room. I'd like to now introduce to you Ronald Appleby. Ron is a graduate in commerce from the University of Toronto in 1965 and a graduate of Osgoode Hall Law School in 1968. He then articled and practiced with Osler, Hoskin, and Harcourt until 1971, and since then has been associated with the firm of Robbins and Robbins. Ron is a taxologist, which means that he's one of the 18 people in Canada who can both comprehend and deal with the Income Tax Act. So I think you'll find his comments very illuminating. Ron?
Thank you, Jack. Ladies and gentlemen, I must say that when Jack first asked me to prepare a paper under the topic advising the small businessman, I was a little disturbed. I thought, what suggestion is there that a small businessman has problems different from a tall businessman? And was somebody trying to suggest perhaps that because of his size, a small businessman was less efficient, less effective an entrepreneur than a tall businessman? Was there some subtle suggestion that I was missing when a small chairman, Jack Ground, asked a small tax lawyer to advise small businessmen? Well, obviously, the title to this program should have been Advising a Person Who Carries on a Small Business, because although a number of the problems that a small business faces are identical except for magnitude to those faced by a large business, there are a number of unique distinctions, a number of particular problems that face persons carrying on a small business. And that's particularly true in the tax field, where perhaps some of the most complex provisions of the legislation affect to a much greater extent the small business than they do the large business, who can better afford to pay for the advice necessary to cope with these problems. Now, that's the small businessman, I'm going to use that term throughout because it's convenient. The small businessman is faced with decisions that have tax implications throughout his business career, from the inception and the decision as to the form of entity, restructuring it from time to time and growing with it, dealing with the profits generated by the business, financing the business, and ultimately disposing of the business. Each of these areas has tax implications. And in my paper, which you have before you, it's the final one in the book, tab D, I've tried to cover what I've felt were the main considerations that you would have to keep in mind in advising your small businessman in a general way with respect to his business problems. Now, I don't propose to cover everything in this lecture that I've dealt with in the paper. That's impossible, and you have it to read at your leisure and to consider and ponder. I do want to discuss with you a number of particular items. First, I'd like to just spend a few minutes canvassing some of the general considerations that you have to keep in mind. The general treatment tax treatment of the proprietor, the partnership, and the corporation. Let's start with the proprietor, just briefly spending a couple of minutes with the proprietor. May be trite, but the proprietor must include in his income for a year the profit that's generated from the business that he carries on. Alternatively, if the business generates a loss, that loss is available to the proprietor in reducing his other income for the year. If the loss exceeds any other income, or if he has no other income and he merely generates a loss from that business, that loss is available to be carried back 1 year and forward 5 years to be applied to reduce any other income in those years. It does not have to be business income. So that is available for the individual proprietor. Now, the individual, of course, will include the profit from the business in his income, and he will be taxed on that income at the steeply progressive marginal rates that are applicable to individuals, rising up to 61% combined federal and provincial, approximately 61%, over $60,000. The individual proprietor will be taxed on a calendar year. His business may have a fiscal period which coincides with the calendar year, in that it ends on December 31. And in that case, it's easy. You take the profit from the business, that's included in his income for the year. But the business need not have a fiscal period ending on December 31. It can have a fiscal period ending on any day in the year. There are certain restrictions. The fiscal period can't be more than 53 weeks, but it can basically end on any day in the year. Now, where you have a fiscal period that ends on a day other than December 31, it's the income for the period ending in a particular calendar year, ending in that calendar year, that is included in computing the individual's income. Let's take a look at the possibilities that opens up for tax planning. There's a little example on page D5. Now, in the example that is posed, Mr. X is an employee until January 31, 1973. Right? On that date, on February 1, he commences to carry on business as a sole proprietor and selects a fiscal period for his business to end on January 31 of each year. All right? So that for calendar year 1973, his business will not have a fiscal period ending in that year. Right? So for 73, he will not include any income from the business in computing his income for 73. His income for 73 will consist only of the 1 month employment income. Right? For 74, he will include the business income for the period February 1, 1973 to January 31, 74. And remember, he will not file his return for 1974 until April of 75. So that effectively, the proprietor has a 2-year deferral of tax liability and tax payment in order to enable him thereby to increase the cash flow that's available for use in the business. Okay? Now, our partnership, there are a couple of important points that I want to make with respect to the partnership. Now, remember that the partnership itself is not an entity which is subject to tax under the Act. The partnership is used as the vehicle for computing income, but it is not taxed as such. The partners, each of the partners will be taxed. The income is computed, the income from the business or undertaking carried on by the partnership is computed at the partnership level, and all deductions must be taken at the partnership level in computing income. In other words, capital cost allowance. Each partner does not take his own share of capital cost allowance or depreciation on the partnership assets. Rather, it must be taken in computing the income of the partnership. Now, the partnership income is computed on a source-by-source basis. In other words, we'll take the total partnership capital gains, the total partnership business income, and allocate that to each partner in accordance with his respective share or interest in the partnership income. Now, that's in computing partnership income. I said that all deductions must be made at the partnership level. I want you to note, though, that that's not in the computation of taxable income. Each partner still computes his own taxable income. In other words, he takes his own marital exemption, his own charitable deduction for charitable donations. As a matter of fact, there's a specific provision that provides that the partners will themselves deduct, take a deduction in computing their taxable income for charitable donations made by the partnership. It's not a major factor, but I point out that the deduction is only available if you were a member of the partnership at the end of the partnership's fiscal period. Otherwise, you don't have any credit for charitable donations made by the partnership. Second point, and I think there was some confusion when the new act came in, many people felt or thought since income is computed at the partnership level, a partner will not be able to deduct any expenses that he incurs outside of the partnership to earn partnership income. Now, that's not correct. There's no restriction of that sort in the Act. If a partner, because of arrangements within the partnership, uses his own automobile, for which he bears the cost personally, in order to earn income for the partnership, the costs attributable to the use of the automobile for business purposes will be deductible by him personally. The second important point to note about the partnership is that the interest in the partnership is now a capital asset, treated in a similar manner to shares, bonds, and other items of capital property, the sale or other disposition of which will result in a capital gain or capital loss. An interest in a partnership is an item of capital property. All right? The adjusted cost base, in other words, the base from which the gain, the capital gain or the capital loss is measured, is his original cost increased basically by increases in his capital account, the income of the partnership, capital contributions, capital gains of the partnership, and reduced by his drawings out of the partnership. That reduces his adjusted cost base. Now, there are a series of complex transitional rules that affect the cost base of a partnership that where a person was a member of the partnership on December 31, 71, but I leave that for another time. The final point I want to make with respect to a partnership at this time is that, as a basic rule, transactions between partners and the partnership, in other words, transfers of assets from the partner to the partnership or distributions from the partnership to the partner, basically must be at fair market value. Now, there are a series of rules and rollovers contained in the Act which will permit, if properly structured, the avoidance of tax implications or deferral of tax implications when assets are transferred into a partnership on the formation of the partnership or out on the dissolution of a partnership in certain circumstances. There are a number of other rollovers in connection with partnerships that I've set out in the paper for your consideration. Let's move then briefly on to the basic considerations of the corporation. Don Cameron discussed with you very briefly the small business deduction. This, in the context of the corporation carrying on a small business, is the prime consideration that you should be aware of. Now, let me just give you a little more background. On page D17, there are a couple of or three definitions that are relevant in applying the small business deduction. You note, first of all, a public corporation, which is a resident Canadian corporation. That's the key thing. It must be resident in Canada, and it's either listed on an exchange or has a large number of shareholders and a wide distribution of its shares. That's a public corporation. It's resident in Canada. Private corporation is one which is resident in Canada. It is not a public corporation, nor is it controlled by any one or more public corporations. Okay, that's a private corporation. Now then, the key one, the key definition for the purpose of the small business deduction is the Canadian controlled private corporation. You'll note that it is a private corporation, which is a Canadian corporation, which means that it is resident in Canada or meets certain other tests, but basically focus on resident in Canada, and that it is not controlled by one or more non-resident persons, public corporations, or any combination. Now, note this point. We call it a Canadian-controlled private corporation. It does not need to be Canadian-controlled. As long as Canadian resident individuals or other private corporations hold 50% of the shares, it will qualify. Or, taking it the other way around, as long as non-resident persons and or public corporations do not control the corporation, it will be a Canadian-controlled private corporation. Okay? So you can have a 50-50 situation between Canadian residents and non-residents, and it will still be a Canadian-controlled private corporation entitled to the small business deduction. Now, what is the small business deduction? Again, Don Cameron referred to it briefly. Taking approximations and ignoring certain special adjustments and reductions, federal corporate tax is 50% in 72, going down 1 percentage point till 76, when it reaches 46% and flattens out thereafter. Now, the Act is designed to provide an incentive to smaller Canadian businesses that are carried on through a corporation, right? But the incentive takes the form of a reduction in tax, a low rate of tax, but applied only to active business income, from an active business carried on in Canada, and subject to two other limitations. The low rate will not be applied to more than $50,000 of active business income in a year. That's called your business limit, effectively your annual business limit. The low rate will not apply to more than $50,000, nor will it apply once the corporation has accumulated in prior years $400,000 active business income. All right? The way that's actually structured is that a third annual limitation is imposed to the extent that $400,000 exceeds the cumulative deduction account. And the cumulative deduction account is the aggregate, basically the aggregate of your active business income up to that point since 1971, since commencing with taxation years starting after 1971, and reduced by a proportion, 4/3 of dividends paid out of that active business income. Now, the actual technicalities are contained in the paper, and I refer you to page D222, where there is an example of a simple example of the operation of this concept of the small business deduction and how it will apply to income earned over a period of years. Now, I want to make one other point in connection with the small business deduction, and that is that even though the low rate is only available to income, active business income, up to $50,000 in a particular year, active business income in excess of that amount does is taken into account in computing that $400,000 figure. So that, for example, if Eaton's earned $500,000 in 1972, it would have the low business rate on $50,000 of income, 472, because it's a Canadian-controlled private corporation. But that would be the end of the small business deduction for Eaton's, because its active business income had already exceeded that accumulated $400,000 figure, unless it paid out substantial dividends. Okay? So income in excess of the $50,000 affects the cumulative total. Now, also remember, you're all familiar with the concept of associated corporations. Corporations that are interrelated based on a series of technical rules in the Act. The low base, the small business deduction, must be apportioned amongst a group of associated corporations. They must apportion both the $50,000 annual business limit and the $400,000 total business limit. It must be allocated amongst the various companies in the group of associated companies. And I've also set out some of the major concepts as to what is or what are the rules with respect to association of companies. Finally, in connection with active business income, there is no definition of what constitutes income from an active business carried on in Canada. There are two departmental circulars that relate to it, interpretation bulletins. I've also set out in the paper a brief discussion of this concept. Note that recapture, for example, on an asset, a depreciable asset that is used in carrying on a business, an active business, that recapture itself is income from an active business. Note also that the sale of goodwill related to an active business, a part of the proceeds of that income, of that sale, are income from an active business. You'll find a number of other highlights in that connection. Now, two other concepts are important. Capital gains, a new concept. It's had a lot of publicity, it's had a lot of promotion. You all know that there's a capital gains tax, that V-day value, valuation day value, is relevant in computing the amount of capital gain or capital loss. I'm not going to spend any time on that. However, there is another concept which I think is appropriate to deal with in this seminar. That is the concept of eligible capital property. The treatment under the new Act of goodwill and what I call other non-depreciable, intangible capital assets. Now, as you know, under the old Act, the person who sold goodwill generally had a non-taxable capital receipt. The person who paid an amount to acquire a goodwill item had a non-deductible, non-depreciable expenditure, which was called, in quotes, a nothing. The new Act, has set up a mechanism designed both to recognize a part of the expenditure for goodwill and other non-depreciable intangible capital assets related to a business, and to tax a part of the proceeds. Now, briefly, let's just focus on goodwill. You sell goodwill and receive an amount in respect of goodwill as a result of a transaction occurring after 1971. And remember that the amount must be related to a business. You have no deduction for and no inclusion in income for any concept of such exists for goodwill related to a property acquired to generate investment income. It must be related to a business that's being carried on. All right, you sell goodwill and you receive an amount after 1971. Right? Or let's take it the other way around. It's easier. You buy goodwill. Okay? You buy goodwill, you spend money to acquire goodwill, or a business including goodwill. One half of that amount, and I'll come to the transitional rules in a second, one half of that amount is set up as a special pool. It's called your cumulative eligible capital account. And one half of the cost of acquiring the goodwill is set up into this pool, and it is depreciable in a sense, in that you can write off 10% of the balance in this account per year. All right? You spend $100 to acquire goodwill, $50 goes into the account, $5 is written off in year one, $4.50 in year two, etc. Okay? Now, you sell goodwill. Forget about the situation where you bought it. You sell goodwill after the new system has commenced. You must include in income a portion of the proceeds that you've received. 1/2, again subject to the transition rules, 1/2, or to the extent that 1/2 exceeds the balance in that cumulative eligible capital account, is brought into income. So that if you have made no expenditures since 1971, and you receive an amount for goodwill, an amount becomes payable for goodwill, you include 1/2 of that amount in your income. All right? Now, I said that that wasn't quite true because there are transitional rules. See, the Act does not recognize, except in one instance, the costs that may have been expended prior to 1972 to create or acquire that goodwill. Nor does it recognize the value of that goodwill on V-Day. But what the Act does do is that it says rather than including 1/2 of the proceeds of sale of goodwill in income, for a transitional period, you'll include a smaller proportion. So that in 1972, if you received an amount, it's 20% in goodwill, in income. 73, 22.5%, increasing by 2.5% up until 1984 when we reached the full 50%. The other exception is that the costs incurred prior to 1972 to acquire a municipal license or franchise, such as liquor license, will be recognized if you sell that asset. It will only be the excess that will be treated in this manner. Okay? Now, even though the vendor is only including in his income a small portion that's increasing, the purchaser includes the full 50% of his cost of the goodwill, except if it's a non-arm's length transaction. And then he's restricted to that same amount, the same percentage. Okay. Now, let's move on a little bit. Your client has come to you and he has said, I'm going to carry on the business. Should I incorporate? Should it be a partnership? Should it be a proprietorship? And again, Don Cameron gave you a number of the major considerations involved, both tax and non-tax. I just want to add a couple of points to what he has said. He pointed out to you that if the business will be generating at a loss at the outset, apart from any other considerations, the tax factors may dictate in favor of a form of entity other than a corporation. Because if the proprietor, for example, has other income and he generates a loss from the business, that loss is available currently to reduce other income. If, however, a corporation is used to carry on the business and it incurs a loss in year one, that loss is not available to be used by the shareholders, but is only available to be used by the corporation, and if it's a new corporation, to be carried forward to reduce income within the next 5 years, if any. So that if you want to utilize a loss, corporate form is not the answer. Okay. The prime consideration, the prime motivating factor, tax-wise, why you would incorporate the proprietorship, is the fact that it's cheaper to finance the corporation through retained earnings than it is to finance the proprietorship through reinvestment of your profits. Right? Remember that the corporation, to the extent that it has the small business deduction available, is only paying tax at 25%. Now, of course, when that income comes out to the shareholder and is either as dividends, it will effectively be taxed at his own marginal rate. But as long as it's staying in the corporation, it's only taxed at 25%. Now, the marginal rates applicable to individuals reach 25%, combined federal and provincial, very quickly. If you take a look at page D41, D42, where I discuss this concept, you'll see that an individual with taxable income in excess of $2,000 has already reached a marginal rate in excess of 25%, only $2,000. Now, you would not incorporate a man, or generally you wouldn't, if he's going to have a business that's going to only earn $2,000 for a number of years. It doesn't pay. All right? The thing that you have to focus on is the cost on the earnings that are being retained in the business. Right? Let's take a look at the example a little ways down the page on D42. Said that a business generates $19,500 profit this year. And $5,000 of this amount is retained in the business and reflected in increased inventory, receivables, etc. Now, if it's a sole proprietorship, Mr. A is going to be taxed on $19,500 no matter what he drew out of the business. If it's a corporation, Mr. A will be taxed only on his salary withdrawn from the corporation, salary paid from the corporation. So that if $5,000 is needed to finance expansion and growth in the business, then the corporate tax on that $5,000 will be only 25%, resulting in a tax of $1,250. The marginal tax on Mr. A as an individual receiving $19,500 income, and I postulate, I think, $16,000 taxable income, he would pay tax of $2,100 on that $5,000 chunk. So that the cost to the business of that $5,000 that's been reinvested is significantly cheaper through the corporation than through Mr. A as a proprietor. Now, here we've got a difference of $950. If the difference were only $100, then the tax factors wouldn't say that you should incorporate, because there are other costs that you're all well aware of in administering and looking after the corporation, your annual returns, your Ontario paid-up capital tax, which I've discussed here and which is something that is becoming much more significant, particularly in terms of small businesses, and I think you should be aware of. Your original incorporation costs, these are all factors that have to be weighed in determining whether it's appropriate or not, from a tax point of view, to incorporate the company, to incorporate the business. Now, there are other considerations as well. The fact that if it's a proprietorship and Mrs. A is an employee of the proprietorship, that her income, her wages, will be added to Mr. A's. Even though she's fulfilling a function as a secretary, saleswoman, or whatever, the income will not be taxed in her hands at her lower marginal rates, but rather at Mr. A's. Similarly, if she is an employee of a partnership, of which Mr. A is a member, the income will be, her income will be taxed in his hands to the extent that of his percentage interest in the partnership. And even if Mrs. A is a partner with Mr. A, the minister has the discretion to add her income, or his, but generally it's hers, her share of the partnership profits to her husband's and tax it all in his hands. The discretionary power in the hands of the minister. So that even in the situations which are bona fide business situations, the opportunities, the availability of income splitting within the family is severely restricted, at least husband and wife, in the proprietorship and partnership situation. This, of course, is not true with the corporation, where If Mrs. A is an employee of the corporation and receives a salary, that salary is taxed in her hands, deductible from the income of the corporation. If Mrs. A is a shareholder of the corporation and has acquired those shares with money which has not been transferred to her by her husband and has acquired those shares from a third party or directly from the corporation, dividends received on those shares, capital gains on those shares, will be taxed in her hands, not in her husband's hands. All right? I've commented on that a little more extensively in the paper. There are also some significant advantages to the corporate form in connection with the availability of deductions for deferment and retirement income purposes. Our proprietor will be able to put money into a registered retirement savings plan and to obtain a deduction in respect of that contribution. And that will be it. Through the corporate form, he will be entitled not only to have the equivalent deduction for his contribution to the registered retirement savings plan, but the corporation will also have a deduction, or could have a deduction, in respect of a deferred profit sharing plan, which the corporation establishes and will be permitted to contribute up to $2,500 in respect of Mr. A, employee of the corporation. Now, the combined deductions available there and the combined contributions that are tax deductible but geared for retirement income purposes are $6,500 as opposed to only the $4,000 in the proprietorship situation. These are only a few of the elements that should be going through your mind in advising your client as to whether or not the corporate form is the appropriate form. Now, your client has decided that he wants to incorporate. He's got a sole proprietorship. Let's deal with the situation where he has been carrying on a proprietorship or a partnership, and the time has come now to incorporate that. Now, the object of the exercise, of your exercise in transferring the assets to a corporation should be, generally, to minimize any immediate tax consequences and to defer them as much as possible. And this presents a problem because the basic rule contained in the Act is that if a person transfers property in a transaction which is not at arm's length for a price which is less than fair market value, he's deemed to have received fair market value. Or if he pays more than fair market value, he's deemed only to have paid fair market value. The basic rule is that the transaction must be a fair market value. This general rule would lead to significant hardship in the situation that we're talking about, a transfer from a proprietorship or a partnership to a company wholly owned by the transferor. It would be a significant hardship if there was a serious tax impact, even though there were no change of economic interest. So the Act has designed a number of mechanisms which can enable you to defer and minimize the tax implications of the immediate transfer. Let me analyze it very briefly on an asset-by-asset basis. Accounts receivable. If Mr. A, our proprietor, has been taking an allowance for doubtful accounts and deducting a reserve in respect of this amount in prior years, that reserve, each year's reserve, must be brought into income in the following year. And not only that, when you dispose of your receivables, when you cease to carry on a business, the entire amount comes into income. That's a rough approximation. Now, the point is this, that if Mr. A has been taking a reserve, a deductible reserve in the prior year, in order to avoid that reserve being brought back into his income, and rather having a flow-through, a follow-through of the allowance for bad debts or allowance for doubtful accounts to the corporation, must follow a procedure whereby both the transferor, the proprietor, and the corporation file an election with the Department of National Revenue under Section 22. The election sets out the face value of the accounts receivable and the amount being deducted, okay? So that it's possible to have a complete rollover, avoid any tax impact on the accounts receivable. Similarly, with respect to inventory, if you've got to sell inventory at fair market value, and fair market value is in excess of your cost, you will have a profit realized on the disposition of that inventory. And the Act says where you sell inventory, when you ceasing to carry on a business or on disposing of a business, it's deemed to have been sold in the course of carrying on a business, which means that it's taxable profit right away. But there is another provision which enables the vendor and the purchaser, where inventory is being sold as part of an overall asset transaction. It enables the vendor and purchaser to allocate a specific amount to the inventory. And the essence of the object here would be to allocate cost, so that the vendor will not realize any inventory profit. The company will realize the full inventory profit when it ultimately disposes of the inventory in the ordinary course of its business. Now, other assets: ordinary non-depreciable capital property, depreciable property, eligible capital property. Remember that goodwill is now results in taxable implications. If you have to sell a depreciable asset at fair market value, you're going to be faced with recapture. You may be also faced with a capital gain, as well as non-depreciable capital property. And transferring the goodwill may result in an inclusion of an eligible capital amount in income. Section 85, which is a section that you've probably all heard of, and very few people have employed this thus far. Section 85 sets out a series of steps to enable this property, your capital property, other depreciable property, goodwill, to be transferred to a corporation in certain circumstances without any immediate tax consequences. Now, in order for this procedure to be available, the transferor must own not less than 80% of the issued shares of each class of the capital of the corporation immediately after the transfer. I'd love to discuss with you what is meant by immediately after the transfer, and I refer you to page D54. I don't have time to talk about it now, but there's a problem there. But anyway, here we've got our situation. We meet the 80% rule because our proprietor is going to own all of the shares. The 85 rollover effectively is this. You transfer the assets at fair market value in terms of the actual consideration being received back by the transferor. But for tax purposes, you're permitted to elect a value within certain limitations which will avoid any tax implications. Thus, if you were transferring capital property, you would elect a value of the adjusted cost base of that capital property. That would mean that you would be deemed to have received only the adjusted cost base, therefore no capital gain. The corporation would be deemed to have paid only the adjusted cost base, and it would realize the capital gain down the road. Similarly, with depreciable property, you would elect undepreciated capital cost so that there would be no recapture, and it would be shifted to the corporation. Now, there are certain limitations. The limitation is, one limitation, and the prime limitation that you must focus on, is that the elected amount may not be less than the value of consideration received on the transfer other than shares of the corporation. Right? You transfer a capital asset with a value of $100 and an adjusted cost base of $50. You receive consideration for the company, from the company. Since the object will be to elect $50 as your elected amount, so that there is no capital gain on the transfer, the non-share consideration, namely cash, promissory notes, assumption of liabilities, attributable to that asset, cannot exceed $50, because if it exceeds $50, you can't elect $50. You can't elect an amount below that non-share consideration. All right? So you could issue a note for $50, and the balance would be preference shares with a par value of $50. Those preference shares would have a zero cost base. Again, I refer you to the paper. Now, unfortunately, I talked too long, and the time is too short. There are a number of other things that I would have liked to have discussed with you. There is an extensive discussion of the tax ramifications of financing the corporation: debt, equity, interest, etc., government grants. And one important thing that I think that you should read, I know that most people don't read these papers, but one important thing that you should read, it's on page 78, D78 to D86. I've dealt there with the considerations involved and the mechanics involved in making elections to distribute free of tax pre-1972 surpluses. And I have found that there is a smaller degree of understanding in this area, even though lawyers are called on every day. The accountant sends in a letter, please deliver to me certified copies of a resolution authorizing election under Section 196, etc. I think that it's important that you understand what you're doing, whether it is in your client's interest, and whether the mechanics are correct. And I refer you to that aspect of the paper. Thank you.
Systems such as they have there.